Good afternoon. Welcome to today's Wednesday market review. My name is Stock Darts, and we're going to do what we always do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. We do that in order to get a good idea of what kind of a market environment we're in, what kind of trading conditions are prevailing, and whether we should change or structure our trades in a different way, or just keep on as we've been doing in the past. If you like what you see here, you can always follow me on Twitter under the name Stock Darts. You can find me on YouTube under the same name, or you can visit me at patreon.com/stockdarts, where I post weekly blog content including trade ideas, watch list ideas, the repost of these Wednesday market reviews, and anything else I can think of. Typically, whatever we decide the right approach is during these Wednesday market reviews is the types of trades I try to recommend in my Patreon page. So if you're looking for a more detailed look into how I trade or what my approach is, that's probably the best place to go. There's a subscription for it to get on-time trade ideas, but everything usually goes free after a few days, so that anyone that wants to learn can still try to learn. Let's go ahead and get started. First thing we're going to do is take a look at the S&P 500 through the ETF SPY. As you can see, we are near all-time highs. We're at all-time highs, and that's going to be the case on most of the major market indices, with the Dow Jones slightly below but still holding steady, and then the Russell 2000 is, when we get to them, you'll see, being the clear laggard. Sam, good to see you in here. It's been a while. The others that are in here, I hope you are going to enjoy the stream. If you guys have any comments, any questions, feel free to type in the chat. I'd love to see what you guys are looking at. Like I said, we're going to cover the major market indices. We'll also take a quick look at the dollar. We'll also look at cryptocurrencies, as well as gold, silver, and oil. Like I said, we're going to get started with the S&P 500 first, and the market continues to rally, and it appears that we're still in a nice markup phase. Now, there's been a little bit of an issue here with the price action in the last few days, and that's because a lot of what we're seeing is characterized by strong market rotation, and it is causing a difficult spot here for a lot of traders, because a lot of the good stocks, they started to take off back here like in the beginning of July, and at this point the risk reward really isn't that great for a lot of new trade ideas. But a lot of the stocks that did well in 2020 were performing kind of poorly as we were kind of making our way upwards, and now they've started to regain momentum, and a lot of the recovery stocks have started to pull back. And so because of that, the indices as a whole are doing pretty well, but there's still a lot of pockets of strength and weakness in the overall markets, and we're still getting pretty mixed price action despite what we see on these major market indices. And so the first thing we're going to do, like I said, is we're going to go and look at these in a little bit detail. And for the S&P 500, assuming this was just a stock in a vacuum, you can see that everything is very positive. We have a breakout to new highs just today. We had new highs yesterday. We had new highs the day before. So about 4 days in a row now, basically sitting at all-time highs. And we had a little bit of a shakeout last week. We came back. We didn't even test the 20-day moving average, and we kind of made our way back upwards. And so we're still seeing positive action from the bulls, and a lot of increased demand. Now, the one thing I would point out is, as nice as this looks, we're not really getting a very decisive move higher. I think we're just kind of trickling upwards, as we've done for the past 3 weeks now. And so I think that we're getting pretty close to a spot where we're going to need to consolidate a little bit further. So my advice to those that are trading, as far as how you want to approach trading over the next week or so, is probably to be a little bit cautious. Now, that being said, we're in a very strong bull market. We have been in one for several years now. And so I think the idea is that you always want to be trying to look towards playing the long game right now. You want to buy dips when you get them, but when you don't have dips, you want to go ahead and try to buy patterns that are emerging, or stocks that are emerging from consolidation patterns. And so the issue I have right now with the market is that we have these kind of spinning candles, right? Yesterday we had a little bit of a doji inverted hammer. Today we've got a little doji hammer again. We had the same sort of behavior last week, and we had that quick shakeout. And it appears to me like we're doing the same thing, where we're starting to see signs of selling. We're starting to see signs of some supply overhead, which is going to impact the price action in the next few days. And I think we're either going to have another shakeout, or we're going to have an actual consolidation range where we start to step sideways and start to come back and maybe make our way back to the 20-day moving average. Now, that doesn't mean that I think that the market is about to top out. It doesn't mean that I think that this is a good place to short the market. I just think it means this is a point where you want to make sure you're not chasing the price action higher. You want to make sure that you are looking for good risk reward scenarios, because the market might be starting to tire out a bit. And the fact that we were able to shake off or shrug off this last shakeout and kind of climb up a little bit is a good sign that buyers are still in control. But that being said, they look like they're still getting tired, and it looks like momentum is starting to wane a little bit. Now, that being said, again, we can continue to climb higher, so that's why we're still looking for stocks that give us good risk reward. A lot of times when you have a market that rotates back and forth like this, the idea is that as certain stocks climb up and need to consolidate, there are other stocks that have not participated that then start to climb up and take their spot, while the stocks that are already at highs kind of slow down and maybe start to trade sideways. And so, like I said, I think that we're in a mixed market. We're in a market that is definitely giving us potential trades if you are aware of where the market is rotating or where the money's going. I don't think everything is trading together anymore. Typically, when you have a very, very strong market, all stocks kind of move together, and it becomes very easy to trade. I think we're in a market right now that is not difficult to trade, but it's not that easy, because you do still have to figure out what areas of the market or what sectors are outperforming and which ones are underperforming. And so that becomes one of the important tasks for a swing trader right now, is to gauge where that is. And we'll take a look at FinViz in a little while and explain how you can go ahead and start looking to figure out where money is rotating in and out of. So what are the key levels in the S&P 500, and what would it tell us if we lose them or do not lose them, right? As far as highs are concerned, we're pretty much sitting at all-time highs, and that means there's no real resistance overhead other than, theoretical resistance. To the downside, however, we have a few key levels that we could watch, right? And so the very short-term level is about 434. I think that's too close to the current price action to really put too much stock into. But that would be the first level you want to watch, which was this area right here where we had these two hammers. Then we were finally able to break through them. And so that would be a spot where you could expect the buyers to kind of come in and step in again. However, just below that, as we approach the 20-day, I think that's the key price point that we want to watch as far as the S&P 500 is concerned, is what we do at the 20-day moving average. I think that's going to be the key. When you have a very strong trend like this, that's usually where you want to watch to see the buyers step in. That is indicative of very strong momentum to the upside, and so that's going to be the first area that gets defended. Below that would be the 50, and I think this is a major line in the sand right now, is this 422 area, which was the last, the ceiling of the last major consolidation range we had. This now, again, major for this year. In the longer term, if we go to a weekly chart, you can see that these are still just little blips in the radar, and they're still just small side steps and small little stair steps within the context of a much longer and stronger rally. You can see that once we had the big COVID drop, we've been in a very basically uninterrupted climb, with only a few stair steps. And you can see we had a nice sideways consolidation for a couple months here. We had one here, we had one here. But even these sideways consolidations stayed within the framework of a channel that's still rising, and we're still kind of in there. I would venture to say that we're probably pretty close to the end of this channel, just because of what I've been seeing as far as the four major market indices working together. But until that actually breaks and we trade sideways, we can just expect it to kind of keep trickling upwards. Which is why I said we don't want to chase price action here, but we do want to kind of trust in it until it proves itself false. And so one of the ways it would prove itself false would be if it fell below this 422 area. So this becomes a pretty critical spot. It is, like I said, the ceiling of the last real consolidation range we've had this year. We've kind of lifted off pretty nicely off of that. And eventually, the market usually comes back and retests these areas. And if it does so relatively quickly, it will have to test the 50-day along with that. And that's two potential areas of support that could fuel buyers to step back in. So it becomes a really key spot that we need to watch. So that would be the major line in the sand as far as whether you want to start to become a little bit more bearish or a little bit more cautious about the market, is what happens at that level. However, the way things are going right now, I don't expect us to hit that level from here to say next Wednesday or so. I think the 20-day is probably the spot that we want to watch, and there's a good chance we don't even get to the 20. But I would expect the 20 to be the key level of support that we would look at as far as trying to buy the dip. So, in the bigger scheme of things, like I said, we are in a pretty good market. We're in a strong bull market. We are climbing upwards, and we're at all-time highs. So, the only negative I could really say is that risk reward is not good because we've gone up so many days out of the last, what is this? Last 10 days, we've basically had 3 red candles, and 2 of them were basically flat compared to the price action from the prior day. So that's the only negative, is that you have to be careful because we're starting to get stretched out and possibly tired. But make sure you don't psych yourself out and get overly negative, because this is still a very strong bull market, and we just want to make sure that we're taking the right trades. But we don't want to try to short this. We don't want to get a little bit of stage fright here, a little bit scared, because we think that the market's up too many days in a row. We just want to make sure that we have good risk reward and good entry or good trade parameters when we take our trades. Let's take a look at the NASDAQ. We're going to see a similar picture with a little bit more strength. Now, the one key difference between the NASDAQ and the S&P 500 is that the NASDAQ has already, we went back and looked at the longer term chart, you can see the NASDAQ already traded sideways for a good chunk of this year. It lost a lot of momentum in March, and this was critical because this was exactly the rotation I was talking about before, where a lot of tech names and a lot of NASDAQ names in particular did very well last year as a response to the way we handled the coronavirus and the fact that we had to stay home and we had to do a lot of our consumption from home. And so a lot of stocks that benefit from that did well. As we start to see more signs of recovery and of with the vaccine and people lifting quarantines and people lifting the ability to go back out and enter stores and all that, these stocks took a hit, and so they started to kind of break sideways, and then they kind of eventually kind of recovered a bit and followed the market upwards, but were really sluggish. And now recently we finally started to see them break out, and I think this is because most of these stocks were good stocks before we ever had the COVID issues. This is not a situation where these were stocks that were only going to benefit from people working at home. These were stocks that were basically giving us a good indication of what our society was moving towards. Amazon was doing well long before we had to worry about the coronavirus. Same with Netflix, the same with a lot of other tech names. The move towards us spending more money at home or working from home was something that was already kind of in place, and the wheels were already in motion, and it was basically accelerated by the coronavirus. And so there was no reason for these stocks to take a big hit, so they just took pauses as people took profits and moved into recovery names, and then now, as they became better values, they started to take off again. And so that's what we're seeing here. You can see this very narrow channel as we've had a very steady rally with these tech names continue to kind of climb higher. Now, just like the S&P 500, I would say this is getting a little bit long in the tooth, and we're maybe reaching a point where the momentum is starting to fade and probably due for a pullback. Now, just like I said with the S&P 500, does that mean I want to short this? Absolutely not. When you have this kind of momentum, I think you put yourself in trouble when you try to get too cute and play a short here. What happens a lot of times is you get this little shakeout like we had last week, and then buyers that missed half of this are going to jump in and chase the price action back upwards. So it's difficult because this is where, as a trader, you need to kind of sit on your hands and you need to be patient. You need to wait for the best kind of trading opportunity. You don't want to chase the price action higher and be the one that gets set up for the shakeout. You don't want to short it because clearly shorting does not work right now. So what do? You just have to wait. You have to wait for a pullback to the proper areas and then try to get your entry then. And that's one of the key things that the market does to traders. Is it tries to goad you into taking bad trades. So it'll do something like this where it trades in a nice little steady channel, trying to force you to come in and break your discipline, and try to chase the price action. And when that happens, when enough traders do that, that's when you get the shakeouts, and that's when you get the moves down, and that's when the smarter money comes in and goes in and takes advantage and buys at value. And so we're in a situation right now where the market is very strong. Like I said, all-time highs, but the trading opportunities are, I wouldn't say non-existent, but they're a little bit sparse because we've gone up just too many days in a row, right? I mean, if you count this from here, what do we've got here? Probably about 25 candles. What do we got? 3, 4, 5 red candles. So, like I said, I think the key here is let's just wait for more consolidation or a drop, or try to figure out where money's rotating into, which, like I said, we'll take a look into FinViz and see if we can get a better idea of what these patterns are. And until that happens, really, we just have to be patient. Now, the key levels on the NASDAQ, eventually this channel is going to break. And when that does, it's very likely that all we're going to do is come back and test the 20. I mentioned this last week, and I think it's important to mention again. For those, I know a lot of traders maybe don't pay too much attention to moving averages because in the end, a lot of times moving averages, because they lag price, they're really just telling you what has already happened. And while that is certainly the case, I think sometimes they give you a good idea of what kind of momentum is really building up underneath the surface. And when you see this pattern right here that I'm pointing out, this is usually indicative of a strong trend beginning to emerge. And that's when you have the 20-day moving average kind of cross through the 50 and climb up. And you see the 50 climb up as well, but they spread out, showing that price is accelerating to the upside, which of course is reflected by this channel. And you have the 200-day moving up as well. That momentum signal is usually pretty good, and it usually is a good harbinger of a strong trend. Now, the one negative or the one thing that's missing here is that the 200 is already pretty spaced out. Typically, for the beginning of a strong trend, you want the 200-day moving average right next to these as they all spread out together. This is more indicative of a mature trend that still is trying to begin a new leg up, but not like maybe what we saw. And I'll backtrack here so you can see. So the last time we had, again, very similar to what we're seeing now, was back here at the kind of like fall of last year, where we saw the 20 break above the 50, and then you see them, they start to spread out. Now the 200 again was further back, so this again was indicative of a trend that's beginning off of a more mature move. However, you can see that we had a very strong rally based off of that, and we rallied for a good 3 or 4 months. And so there's a case that we're going to see something similar. We'd have to go pretty far back before we reach the spot where they were moving together, and it's going to be right around here. So if you look at back in April of 2020, which is basically right after the coronavirus drop, I think. With the weekly chart, it's going to be difficult to. Wow, that really went backwards. It was right here, and I'll zoom back into the daily chart, and you can see we had a massive rally the last time the moving averages were all bunched up together. And so we're not there. Like I said, we're more in a spot that's very similar to what we saw last winter. However, that is still potential for a rally that lasts throughout the summer months. And so even if this current short-term price action gets tired and we pull back, I think we're seeing footprints of the beginning of a stronger rally. Now, there are a couple little asterisks that we can put to this rally, and one of them is going to be IWM, and we get to them in a second. And so that might be one of these situations where we have other indices that are lagging that are going to kind of hold us back. But if we're just looking at the NASDAQ in a vacuum, this looks like the beginnings of a very promising rally. And what we would need right now would be a retest of this. Now, just like the S&P 500, I don't expect price action to lose the 20-day moving average from here to next week. The real strong level, however, if for whatever reason we did get a stronger sell-off, is down here, which is the ceiling of the last consolidation range we had this year. So anything around 342 or so, that's going to be the new floor, it was the previous ceiling. That should be the new floor that we don't lose. That will also coincide with the 50, which again is a pretty key indicator to watch on a strongly trending market. I find that the moving averages lose a lot of significance when the market is flat. However, when the market is climbing, they tend to be pretty reliable indicators of good support or potential support. So that is going to be the key area to watch, and that's going to be a major buy in the dip opportunity if we get to that. However, depending on how we get there, that could changed the picture a bit. But those are going to be the key levels right now, is the 20-day moving average and then this 343 or so area. To the upside, nothing other than this channel, and that's basically it. So again, very strong trending market. The key is not to chase price action, because it's going to try to get us to chase it. And the longer this persists, the more likely that when we do correct, it will be with probably a semi-big red candle, as it shakes out the weaker hands that kept trying to chase the price action. So everything I said with the S&P 500 stands for the NASDAQ. It's very strong, particularly in the short term, or in the long term, of course. And so really it's just a matter of us making sure we get our timing correct. Now, the Dow Jones was lagging a bit compared to the S&P and the NASDAQ just a couple of weeks ago. It has played a little bit of catch-up. It hasn't actually broken to new all-time highs, but it's sitting right beneath them. It actually did a pretty decent job of staving off a potential drop through a key area. You can see we had a shakeout candle here, which was immediately bought up with buyers. This was a pretty good reversal signal, and that immediately led to a rally right back to where we are now, which is near highs. Now, the moving averages are tied together, the 20 and the 50, so we haven't seen that extension of the rally that we saw in the S&P 500 and the NASDAQ. It could be building up to that, and if we get a breakout and these moving averages start to spread out and climb upwards, that could show us that the momentum is returning to the Dow, and it's going to follow the NASDAQ and the S&P 500 higher. Now, this is the other side of that rotation game that we were talking about. A lot of the Dow names are names that really struggled in 2020. You know, things like Boeing, Deere, Caterpillar. They have a lot of industrial names, or a lot of names that kind of depend on a society that is not staying home all day. And so the Dow Jones really took off and started to really become a leader as far as the four major marketers indices are concerned, when we started to get a pretty good, a critical mass of our population being vaccinated. And that led to a pretty good rally, and like I said, a pullback in the tech names. Now we've kind of flipped the switch again, and a lot of these Dow names that rallied, people took profits and moved it right back into a lot of the tech names. And so that led to what we saw here, which was some bearish price action in the short term. But overall, it did the same thing that the other indices did, which is basically just consolidate and make a nice long sideways trend, but within the context of the overall or the framework of the longer term trend upwards. And we didn't really break that channel yet. I think this is a channel that needs to break, and we're probably getting pretty close to that. But until it does, we can assume that the Dow is going to try to climb. So that means that there is a pretty good chance that the Dow will break out, or will try to break out in the next couple of days, and follow the S&P 500 and the NASDAQ higher. Now, if the Dow fails that breakout and heads back down, well, we have a key test coming up, and it's a pretty critical test, which is the 20 and the 50-day and the bottom of this channel all coming up together. And so that's going to be really important for us to watch. I typically don't pay too much attention to the Dow, because I believe most of the market you could kind of gauge from the S&P 500 and the NASDAQ. But this is one of those points where I think the Dow will give us a good indicator of what's going to happen overall in the markets. If we breach these two moving averages and this channel and start to fall back towards this 340, 335 area, I think that's going to tell us that the S&P 500 and the NASDAQ are going to take a breather and come back and test some of those support areas that we pointed out earlier. If the Dow Jones can accelerate and break out, then I think we're going to see a stronger rally come into place of the S&P 500 and the NASDAQ. Like I said, we'll get to IWM in a second. The Russell 2000 is doing its own thing right now. So we have a pretty critical test coming, and that's going to be the key, is what happens with the Dow as we get closer and closer to this intersection of trend lines. Now, the trend line to me is not quite as important as the 20 and the 50-day, but it is a pretty decent trend line that's held for most of this year, with only a couple of shakeouts that really kind of broke below it. A lot of traders would probably try to adjust the trend line to fix this and to allow to put this in there, but I think sometimes trend lines are supposed to break, and so I don't have a problem with my trend line having a few key breaks in it. I think it's, if anything, it gives you a better picture of what could happen, because there's been 3 times now that we try to break the price action and buyers immediately step in. Now, obviously, the longer that this goes on, the more likely that buyers will eventually abandon it. But that's going to be the thing we want to watch: is what happens the next time we breach this. Is it going to be here? And if so, are we going to get another immediate shakeout and buying attempt from the bulls, or are we finally going to kind of roll over and start to trade more sideways and maybe start to retest some support levels? And so this is one of the indices that we need to pay attention to over the next week or two to see how it navigates either these highs or these potential support areas that are supposed to support the potential for the rally to continue further. And then finally, we got the small caps. We have IWM. And like you can see, a totally different picture here. We actually have red candles. We're nowhere near all-time highs. We kind of rolled right back through the moving averages. And so this is again, I think partly a reflection of capital rotation away from recovery names, energy maybe. And in the bigger scheme of things, it's not really that scary. But I think it tells us that traders are really focused or zeroing in on tech names more than they are on just kind of banking on an overall market recovery right now or market rally. And so I think the key to watch here is will IWM, will the small caps start to regain some momentum? And I think if the Dow Jones starts to break out, we'll see the small caps break right through their moving averages and start to head right back as traders get a little bit more appetite for risk. I think that they still need a little bit of convincing, and part of that is going to come from the Dow Jones participating. And if that's the case, then maybe we can see IWM start to maybe firm up a bit and make its way back upwards. Now, if the Dow Jones breaks those two moving averages we pointed out and its channel, I think IWM is going to lead the way even further and make its way all the way back down to 208. Now, that's going to be an important area, of course. As you can see, that has been the floor for the price action, basically for all of 2021. You can see we started the year, and we broke out, and then we came back, and our first real pullback, we tested that area, and then we broke out, and then we came back, retested, and so that's going to be important. You can see it's going to line up right with the 200 moving average. So this is, I think, one of the bigger signs as well for those that are maybe a little bit more skeptical of this market. And think that we should be either pulling back further or at the very least maybe not rallying. If the small caps lose 207, I think that's going to be a potential end to whatever the S&P 500 and the NASDAQ are doing. I think right now they're fine with ignoring the small caps because the small caps are just kind of churning sideways. But if the small caps start to lose key levels, I think there's a pretty decent chance that a very good chance that that's going to impact the other three indices. And while they may not roll over and head to new lows, they most certainly will stop rallying and will start to trade more sideways at the very least and have to backtrack and retest support levels. So just like the Dow Jones, I think gives us a pretty immediate test as far as what kind of resolve the bulls have when defending a part of the market that's not rallying. I think the small caps will be a very key test coming in the next month or so if we head back down to 208. Now again, I don't expect us to hit this next week. But if the next few weeks or so we start to come back and test these levels, then I think that becomes a critical test for the overall markets. For now, though, it's churning sideways. It's right in the middle of its range between the ceiling around 233 and the floor around 207. And it's basically right in the middle of that around 220. And so it's just going sideways. And I think that at this point, it's not something we want to trade too much. My focus right now would be on tech. Now, that being said, if I see small cap or Dow names that are emerging from nice consolidation ranges, I think this is a good place to keep an eye on them because if they bounce, it would indicate a strong market rally and means they would probably play some pretty good catch-up. So while tech is relatively speaking the strong area right now, I think that if we see some of these recovery names and some of these Dow and IWM names give us good entry patterns, it might be the signs of a bounce back to highs. And now if we see them faltering and failing, then that would tell us that there's a good chance that we have to head back down lower. And so that's my thought process as far as the four major market indices are concerned. We have a little bit of a mixed bag, like I said. If you look at the S&P 500 and the NASDAQ, it looks like we're just in pretty much straight rally mode. If you look at the Dow Jones, it looks like we're kind of consolidating and we're not sure what to do next. And if we look at IWM, it looks like a market that's starting to top out and start to roll over. I think in the end, the leaders usually lead the way. So the S&P 500 and the NASDAQ are probably the ones dictating where price action is going now. I think, however, if the Dow and IWM break those key levels I just pointed out, they will certainly drag the other two with them. And so, like I said, where does that lead us trading wise? We got to be patient and we got to look for strength. We got to try to figure out where the money's rotating. So, what we could do here, real quick, before we get into the US dollar, we can look at FinViz and we can go to our maps. Take a look at the heat map and see what's going on. And like I said, you can see everything. There's a lot of green today with oil, energy down. You've got healthcare down. You've got the financials down. And so we can see clear spots where we're starting to see some pockets of red. Now that's just one day, right? But you can go to 1 week. And same thing, you could go to 1 month, right? And you could get longer, you could get trends of exactly where pockets of strength and pockets of weakness have been over the last month. And you're going to see a lot of the same people, or a lot of the same candidates. Energy down, industrials down, financials down. Meanwhile, technology, strong green. Communication, which is also tech, strong green. Some consumer cyclical, again, Amazon, strong green, which is it telling us exactly what I just mentioned, which is that a lot of the areas that are doing well are the ones that basically were the strong 2020 names. I mean, look, Apple, Google, Netflix, Amazon. Tesla's up today, although they're still kind of neutral in the longer term, or up this month, I guess. But you get a better picture of what's going on, and you can also look at it here in the groups. And you'll see the same thing in these little bars, right? So what's doing well today, what's doing well over the last week, what's doing well over the last month. Now, one thing to point out, real estate is one I didn't mention, but real estate is doing actually pretty well, holding up pretty steady over the last week, last day, and then over the last half year or so. And so from there, you would go into your screener and you try to take a look and you try to dig in a little bit deeper. You can go to the industry and pick out what you want, or you can go to the sector. Industrials you can see are probably going to be the ones that are down, but you can go to real estate and start to really dig in and start to figure out what it is that's looking good and what it is that's looking bad, and try to figure out stocks, maybe something like this that's in a consolidation range. Has pulled back and is setting up for a possible move in the near future, depending on what it does, right? And so this is one way that I like to go once I figure out exactly what I think the markets are doing, what kind of environment we're in, I'll go in and I'll dig in there, especially in a market like this where we have mixed signals. We have areas that are strong and areas that are weak. Well, you want to dig in and look for what areas are strong and weak, but you don't want to just pick the ones that are strong. You want to look for the ones that have a possibility of rotating and becoming strong. Because what good is it for you to try to buy, say, Apple has been doing well. Well, what good is it for you to buy it now when it's been up basically from 125, which, by the way, was one of my recommended trades on Patreon, was Apple as it broke this triangle here. And that has been a massive trade for me and for us. But what good is it for you to try to trade it now when it's already gone up from 122 to 150? At this point, it's made its move. So what you want to do is you want to look for the next one that does this. And that might mean that you find stocks that don't work out, but what you're looking for are stocks that when they do break out, they work for you. And if they don't work out, then they don't even give you an entry signal, right? And try to trade that way. And so that's kind of the process that I've been really working on this year when a market is the way it is right now, which is basically kind of taking turns rallying in different spots, all right? All right, so let's look real quick. Here's the U.S. dollar. Now the U.S. dollar is starting to show signs of good strength. That sometimes when that happens, that actually bodes poorly for the market, but not necessarily all the time. So I think for now that's not a relationship we need to worry about. I think we need to worry about it more along the lines of what it's doing with commodities. And as you can see, we had last week, we looked like we were breaking out, and then we kind of pulled back, and then this week again we opened up, and I've really tried to make a move yesterday, and it faltered a bit today, but basically it's trying to break through this $25 range. And if you look at it on the Euro US dollar chart, it's going to be a mirror, but inverse, because again, this chart is priced in euros. And you can see, so in this case, the US dollar is trying to break down as the euro is the one that's trying to come upwards. And again, you can see that it actually exerted some pressure, and the euro kind of responded, but it's right at a pretty important area as it tries to stabilize. What happens here is pretty important as far as what we can expect out of all the markets, because for the most part, everything still goes by the U.S. dollar. If the euro could get back above 119, then that should make the U.S. dollar behave much weaker. And if we lose this 117 area, then that would be a pretty good sign of impending U.S. dollar strength. If we look at the U.S. dollar versus the yen, it actually lost track a bit. It kind of fell down. It finally lost this channel, came up, retested, tried to get back in and failed. This is a classic shorting pattern, and it looks like it's headed back down. At the very least, to keep testing its 50, which it's already at 109, and then maybe even makes its way all the way back to 108. So this is actually kind of a key spot here, because it's the first real sign of U.S. dollar weakness that we've seen in a couple of months, ever since it finally stabilized. So this would be something that's important, but it might be a function of Japanese yen strength. On the opposite side of that, the U.S. dollar versus the Canadian, we've got a nice cup and handle that it made, and then it started to make its way back upwards. And I think this is threatening a much stronger rally coming in the near future, and a part of that is because of what's happening with oil. As you can see, oil is starting to maybe reach a near-term top around $75. If it cannot break out above that, it's going to break down, and it's going to head back and test the 50-day and maybe even come all the way down to 66. If oil does that, then I would expect the U.S. Canadian to kind of climb a bit further. So for those of you that are capable of trading Forex, keep an eye on the U.S. Canadian as a possible bullish trade. I think the other two, it's still pretty mixed as to what they could do. And then finally, the U.S. dollar's fluctuations back and forth are going to impact gold and silver. As you can see, gold's starting to make a move, which is interesting because the dollar is still firming up, but it kind of made its way back and tested a pretty important trend line in the long term. We'll look at it in the weekly chart. You can see that it came down and broke below it and then made its way back up. This is I guess a good job by gold to kind of make its way back above it. I'm still leery of trading it. And if we look at silver, it's going to be a different picture, but the same basic concept, which is it's trying to make its way back up after kind of stabilizing. I think silver actually looks okay for someone that wants to trade it right now. But I personally feel like there's a little bit of uncertainty right now with where the dollar wants to go, and I think because it impacts gold and silver so much, it makes me a little bit more skeptical on trading these. So again, like I've said for a good portion of the last year, I'm not that interested in gold and silver. And as you can see, really, silver hasn't done anything in a while, so there have been much better trading opportunities. Now, it did have this nice rally, so you know, for those that look at it carefully, you could find spots to trade it. I'm not saying this is untradeable. I'm just saying it doesn't interest me. And then finally, I like to look at Bitcoin and Ethereum nowadays because I consider these to be good inverse dollar plays as well. And I consider this to be actually one of the areas, at this point, I trade cryptocurrencies as much, if not more, than I do stocks. I know I don't really recommend a lot of trades on there because I think a lot of traders that follow me still don't really like cryptocurrencies, but I find that I kind of have found myself focusing more on this than even on stocks. However, that being said, if you take a look at where Bitcoin is right now, we are at a critical juncture, and there's the possibility for a strong move coming in either direction. You can see that it's tried for a while now to bottom out at about 30,000, and it's tried a few times to bounce, and it keeps failing right around 40. And it's been knocked down quite a few times now as it tries to make its way back above the 20-day moving average. We're right at a spot here. I'm going to go ahead and reappropriate this trend line. Where something's going to have to give. Either Bitcoin's going to drop and head down probably to about 25K or 27, 26, somewhere in this range, or it's going to break out and make its way back up to 40. So for anyone that is looking to trade cryptocurrencies, maybe you don't have Bitcoin yet and you are thinking about it, if it could get back above, say, 33 or so, 34, and above the 20-day moving average, I think there's a very good chance it gets back to 40. If it drops and breaks below these 31 to 30, then there's a pretty decent chance it's going to drop another 2,000 or 3,000 as well. And then the sister, of course, is Ethereum. And Ethereum is kind of struggling as well. If you take a look, this area around 2167, just below 2200, is pretty important, and it kind of broke down again. It's struggling to hold above its 200-day moving average, and this again is a potential. Now I could basically clone this and add another support level down here, which is where all the wicks are, which is kind of coincides with this breakout. So there is a floor here that it's trying to hold above. So in a lot of ways, it's very similar to Bitcoin in that it's trying to hold a key level while at the same time dealing with a lot of pressure being exerted by this trend that is starting to really come into place here. And so there's going to be a point here where it's going to need to break out. And if it breaks out above 2200 or so, I think it becomes a very quick shot right back to 2800. If it falters here, then I think that we could head quite a bit lower, as this would be a major level that it fails. And so for anyone that's into this, this is a spot that you want to watch over the next week or so to see what they do, because there could be some potential big fluctuations coming in the cryptocurrency markets. All right, so that covers what I wanted to talk about. Those of you that are in here, Sam, if you have anything you want me to look at, feel free to type it into the chat. We have a little bit of time if you want me to look at some charts. If not, then we could kind of wrap it up here. But love to see what you guys are thinking and what you guys are looking at. I'll type it out just in case maybe someone's audio is a little low. Oh, okay, Sam. So you say you have nothing, you just want to listen. You've been struggling with reaching your goal with discipline. You know, I guess that our closing thoughts will be about that if you want, if I can help you with that. So this is what you're talking about right now, Sam, is one of the reasons that I do these Wednesday webinars, or these Wednesday streams, is because a lot of times with traders, you have periods where you trade well and you have periods where you trade poorly. And sometimes it's due to us, right? Sometimes it's due to the way our mentality. Just like anything else, we have points where we trade well, we have points where we trade poorly. But I think sometimes what happens is it's the market. And there are times where the market gives us good opportunities, and there are times where the market gives us bad opportunities. And so that's why I tend to really focus on what the market does, and why I do these things for free. Even a lot of times I don't get too many viewers in these, but it doesn't matter, because this is still something that helps me kind of visualize and contextualize what the market is doing. Because what I find is a lot of times if I'm trading poorly, it's because I'm trying to do something the market is not allowing. And that's why it's important to have your discipline, is to understand, and obviously you and I have gone over your trading plan before, and we know what you're looking for, what you're not looking for. But what I found is, if the market is not giving me trades, and that's part of why I also look at Forex and why I look at cryptocurrencies, what I find is sometimes the market doesn't want to give me something, but maybe another part of the market does, right? And so looking at, say, just this year, right? We're going to go back and take a look at the market since what happened in November. A lot of traders last year, and there was a lot of, I interact with a lot of people, both professional traders and amateur traders, and everybody was very happy in November, December, January, March, because the market was giving everything to everybody. Everything was moving up together, and it became an easy time to trade. And then we entered into the March, April area, and while the market as a whole held up and didn't do anything bad, individually there was a lot of stocks that were going back and forth, and a lot of traders started to really struggle, and they started to have problems becoming profitable, because they were still trying to trade with the mentality of what was happening here. And while in the bigger scheme of things, yeah, the market just stayed trading sideways, but there was a lot of back and forth shaking out here. And so when I see the market start to do this, you can see the. Remember, I outlined for those that maybe see this or see the recording, I outlined this broadening wedge. We're going to zoom in on just that right there. Whoop. When you start to see volatility increase, and you start to see these kind of broadening wedges, right? The opposite of the triangles that I like to look at. This is indicative of a market that's starting to grow towards indecision, and it's not trading in cohesion. This is usually where traders really get chopped up. And what happens is, as this happens, they lose confidence, and then they start to get scared of trading, and then they start to take, either they get overly cautious and they take poor trades, or they don't trade altogether. Uh, on the opposite end of this is where traders get overly bold, and they start to take too many trades, or trades that they think, because at this point the market is erasing all your mistakes. And what happens almost always is you get these points where you're like this, and then when it hits, it slides into this, and if you started to get a little bit more lax because so much was working, you get hammered here. And then what happens is you get hammered here and you lose confidence. And so what happens then is you get nervous and you don't take the trades you're supposed to, and then you miss this. And what happens then? You get nervous because you missed all of this, so you start to chase. And then what happens? You get hammered as the market does this again, right? And it starts to trade sideways. And so what happens? You get nervous. You don't want to take trades because you're getting hit hard because it keeps going back and forth. Then finally you get the entry you're supposed to. You don't take it because you're too scared. What happens? The market starts to climb upwards. And then what happens? You miss this, so you want to chase again, right? And so this is all not necessarily just a function of you. It's a function of what the market is doing and what the market is providing you. And so I found that what works the best for me is to make sure I understand as we move forward what the market is giving us. And if I don't like what the market is giving us, well then, look at other markets, right? Look at Forex, see what it's doing during those times, or look at cryptocurrencies. Now, for a good portion of this year, when the stock market was not giving me stuff, cryptocurrencies were giving me massive moves. And they were giving me really good opportunities to take advantage of big moves in the market. Now, of course, the converse of that is that there are strong corrections as well. But if you're a trader, you have to understand what your risk is and what your best opportunities are. All right, so let's take a look. You say JP Morgan. You entered JP Morgan with a put in June. So let's take a look. Okay. So you entered with put selling in June. Okay, so right here, see that is, okay, did you, one time, okay, well, I'm not sure, so June is of course a big month, right, like all the months, so I'm not sure if, I'm hoping that you entered around here, as your puts expired, and then you were able to, so one time I was 4,000 on my account, I kept it holding and started selling calls, you liquidated just before earnings, it worked, and you're able to close it with some, okay, so that worked out pretty well for you. So that's good, but so you gotta let that work for you then, you gotta, oh, you were down 4K. Well then, you might have, when did you, at what level did you draw? Oh, 160. Oh yeah, see that's way too close to sell puts. You don't want to sell puts as an entry technique unless you are at long-term lows. That's way too high. The 160 level is way too high to sell puts. 155, even 155. 155 is a good entry for a trade, right? So let's take a look at what you were looking at, right? All right, so here's a quick take on JP Morgan, right? And so these trend lines, they were in place long before that trade ever took place, right? So we don't, it's not like it's just based off of backtracking. Um, you sold two puts at 160 and two at 155. Okay, so the put at 160, this is by far too early. I mean, way too early to sell a put. Now, is it a spot where you could try to make a trade? Possibly, but not based off of this candle, right? So I'm going to zoom in. And again, so before that ever happened, right? Let's take a look here. Now, I'm going to go ahead and say the first thing before we even continue. Like I said before, I don't like shorting this market. Now, again, you weren't shorting the market. You're trying to enter. But when I try to buy dips in this market, I want to do two things. One, I want to buy them at support. And two, I want to buy coming off of consolidation ranges. Now, if you're selling puts, then you kind of have to forget about the consolidation range, because you want to sell puts on days where there's strong volatility or strong premium. Okay, so I'll understand what you're saying is what your entries are as far as volatility is concerned, because on big red candle days, that's when the puts really give you good premium. But taking a look at it here, if I'm looking at this and I'm thinking to myself, I want to start to enter trades based off of selling puts, I would say the first place I want to look at selling puts is 155, and then 140, 145, 146. Whatever the strikes are. I'm not sure if these are 5 or 250 or whatever they are. But 160 is way too early, because that's just, you can see we had a range here, we broke out, and more likely than not, if we lose the 20-day, we're going to come back and test the 50-day. So what ended up happening? It broke the 20 and it went straight to the 50, and it actually just went right past the 50 and came up and tested this level. Now, if you had not sold the 160s, if you started with 155, then you would have had room to add at 147, 145, whatever it is. And then you would have maybe been better off as it finally made its way back up. And so I think the problem there stems with the fact that you went in way too early. And like I said, this happens a lot in these kinds of markets, because you feel like you're missing opportunities, and then you try to make up for it by taking trades before they're ready to be taken. And I think, for me particularly, I don't like to sell puts until a move has exhausted itself. And so you have to think to yourself, we just had, and again, we're going to go back and take a look, right? We just had this channel. We broke out. We had this nice trend to the upside. On this breakdown, that first 3-day move, that's not enough to sell puts, because yes, it could bounce here. But if it bounces here, I would much prefer to just trade the stock and and play the momentum upwards. I don't think that, usually when you sell a put, because it's such a dangerous technique, because you're going to be assigned so many shares, you don't want to sell a put until you feel that the move has exhausted itself. It's not the same as just entering a long trade. There are different tools for different techniques. And in this particular situation, if I wanted to play a bounce on JP Morgan at the 160 level, and let's say, I would say with shares, but if, let's say for whatever reason, your count is small and you can't buy shares, you need to do it with options, I would not buy a call until I saw the price action calm down and set up an entry technique, which, looking at this entire move, might not have happened. And if it did happen, it would have been here. At the most likely scenario would have been this. Once I see a move, and then I see a consolidation range, and then I see a breakout, that would possibly be the first place that I'd look at buying a call, and it would be a 50-50 bet. Now, like I said, selling puts, when do you want to sell puts? Well, you want to wait for this to exhaust itself. So you want to have not only one strong move, but you want to see it actually kind of keep losing ground till it reaches a point where there has to be a bounce coming. And then at that point, you've given yourself a lot more margin for error, because it's already exhausted through a lot of key support areas. And I think you were way, way too early on this. And that happens a lot. Uh, I've often said it when we discuss psychology of trading. The psychology or the fear of missing out is actually much, much more dangerous than the fear of losing and the fear of loss. I think a lot of traders think that the key is to make sure that you don't get too scared when stocks drop. But I think the big thing is a lot of traders get in early because they're scared they're going to miss their move, and that's one of the hardest things to really break through. And that is one of the biggest reasons why I embraced a trading style that incorporates trend lines. So I'm going to show you a trade that did not work out. I forgot the ticker. It's MGNI. So here's one of the trades I was looking at this week, right? And I knew there was a good chance the trade was not going to work. But what I wanted was a trade that, if it did work, would give me an easy trade to trade to navigate and a high probability of success if it worked, right? So I'm looking at this one, MGNI. You can see it has a very clear level of what was support and turned into resistance, and then it flipped again. Now, I was looking at it on Monday after it had already failed this breakout, but it doesn't matter what day you look at it. What you want to see is this, right? And so when you have this, this tells you that whether you're early or late, right? You look at that trend line and consider what the thought process is here. Basically, I want MGNI to confirm 33 as support and to bounce. Some traders would see this green candle and they'd immediately jump in, but they're early because it hasn't concluded or really proven that it's ready to bounce. And so what happens next is it tries, it fails, it tries, it fails. Now this is what I looked at. It was this failure. I know that's at this point it's already down, but basically my idea in this case is if this is a shakeout and it could get back above 33.40, 33.50 and break this trend line and break this horizontal move and break the 2080 moving average, well then that will show that there's enough buyers in there to give me the momentum I need to not only get back to this 37, but probably beyond it back to 42 and possibly up to 50. And so far it didn't work, right? It just kept kind of fading, but that's good because I didn't even enter the trade because it never gave me what I wanted. And so what I found, and maybe this isn't for everybody, or maybe it's something you only want to use when you are struggling like you are right now, is I would say look at trend lines and incorporate them and tell yourself I will not enter this trade until it breaks through the trend line, because the trend line is telling me whether or not buyers are coming back into it. I understand there's and I know you're not this person because you've taken a lot of mentoring with me, so you see what I see to a certain extent, but there's a lot of there are a lot of traders out there that think trend lines don't mean anything and that it's just someone connecting dots on a chart. And while to a certain extent you are just kind of connecting dots, I think that a trend line tells you what traders are thinking. I think it's a very good definition of sentiment on a stock. And if you are trying to trade, particularly when you're trying to trade bounces or you're trying to trade counter trend, you want to see sentiment shift. And the easiest way to see that is when the candles start to break these trends. That's what a trend line tells you. It tells you right now that the sentiment is negative in the short term. In the long term, it's kind of mixed. And in the intermediate term, you could be bullish depending on what time frame you're looking at. But in the very short term, it's bearish. And what you want to see is you want to see that flip, and you want to see a flip to positive. This still could give me a green candle in the next day or two and get back above 32. And then it could still work out as a decent trading opportunity. But until it breaks that trend line, until it breaks above 31.50, 32, I have no interest in it. And I'm not going to enter early because there's no reason to enter early because the stock hasn't done anything that tells you it wants to go through that. Okay? And so if you find that you're having trouble getting in too early and chasing trades, put some trend lines in there for you. Now, I know with put selling, it's a little bit different because you don't want to sell puts when trend lines are converging because that means premium is dropping. You want to sell them when you have big red candles, but in that case, you need to have a better plan. I think the better, you don't want to do it too quickly because you're not going to get enough out of it. Yeah. Well, like I said, that's the tricky part with selling puts, though, is because if you're selling puts, then you can't use these kinds of patterns because by that point a lot of the premium is gone. You want the premium when it explodes like this. Uh, However, I will say one thing, Sam, is what I found a lot of times with selling puts is that I prefer to sell puts as a technique to add to a trade, not as an entry technique. And the reason for that is because you're absorbing a lot of risk for a pretty small reward. Um, and so unless you're planning on getting an entry, if you're planning on getting an entry, that means you're looking for a long-term stock. Yeah, no, that's fine, and it's understandable. But here's the thing. So even if we wanted to go look at JP Morgan, so typically, if you're trying to enter with puts, you're doing it because you want to enter a stock and you want a good adjusted cost on it. Usually you do that if you're looking for a long-term hold. You don't do that if you're looking for a quick swing trade. And I think that might be an issue. Maybe you're trying to pitch and hold this into a short-term bounce. And if you're doing that, the risk reward just doesn't pay out because you're planning on picking up, say, I mean, I don't know what what you were looking for, but typically I notice on these, you're picking up maybe 50 cents, and you're risking $1, $2 of downside at the very least because you're going to get assigned shares. If you're just trying to collect premium, there are better ways to collect premium. If you're trying to get into a stock for long term, then you need to be more patient and you need to give it more time to work in your favor. If you get assigned shares, it's because you want the stock and you want to hold it longer term. And you really didn't give it a lot of time because you got into a position that was too big, according to your bank account, I'm assuming. So that's the other thing is try to understand from the top down, why are you entering, why are you selling puts? Is it exactly? And so you need to have those questions answered before you actually enter the trade. Because that's important. If you're trying to sell puts, that needs to be a technique it's a technique that you use to lower your cost basis on shares. I don't even like to use it for my initial entry because a lot of times what happens is if it bounces, then you miss the entire move and you just collected pennies. And if it drops, well, then you enter too early and you get kind of punished. So what I like to do on something like this is I like to buy shares on my first opportunity and then sell puts if it drops back to that price or below, as that lowers my cost basis and I'm already in. And then that way I have the potential for a bounce that gives me good returns instead of a bounce that just gives me whatever the premium was. Okay? So that's something you need to really kind of step back and reevaluate is why you're doing what you're doing. Okay? No problem, Sam. I hope that helps. Probably need to wrap it up today, but you have my Twitter, you have my email, so you can always message me if you have any other questions. Anyone else on here, I hope this was informative for you, and I hope that this helped. If anyone has questions, you can always ask me on Twitter at StockDarts. I'd be more than happy to help. Other than that, I hope you guys have a good rest of this week, and we'll meet again next Wednesday. No problem, Sam. Have a good rest of the week, okay? And it was good talking to you. It's been a while since we see each other.